Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar where we'll take a look at valuation is actually not a catalyst. I'm very pleased to have with us Keith McCullough, who is the founder and CEO of Hedgeye Risk Management. Keith is going to be delivering today's presentation and will also be answering any of your questions later on in today's session. I also will be taking you out to the Interactive Brokers website where you can find out more about Hedgeye Risk Management and even request a sample copy of their of their research reports. So with that, what I am going to do is let me take this. I'm going to bring Keith on. Keith, I'm going to pass you the controls right now, and if you can make sure that your screen, bring your slides up, we'll get underway here today. Thanks for joining us, Keith.
Great. Thank you very much. I'm just delighted to have an opportunity to walk through our current views on the market and the simple point that we always make, which is valuation, while it's interesting for people to talk about and it certainly matters, it's definitely not a market catalyst for a decline. So again, we'll walk through why that is market history. That's not my opinion. Valuation, again, is not a catalyst. What we would need to see for this market to stop going down are things like U.S. GDP growth, U.S. profit growth to decline, for example. Now that would be a catalyst, and from a certain valuation level, that would, of course, matter. So the first thing that I want to do is jump into our process here in this slide deck, and without a process, I don't really think that I would have anything to say. Our process is differentiated at a bare minimum, at a maximum. It's helped this year to define why U.S. growth investing was the right place to be. How we look at, if you're on slide 3 right now, how we look at the world really has 3 core components. We think about history a lot. We think about math, obviously, and we deal in behavioral psychology space where the behavioral factors of the market are quite important, and those include price, volume, volatility signals, and they also they consider positioning, or where the market might be relative to where consensus positioning is. Whereas you'll hear a lot of macro strategists talk from a consensus perspective on what actually just happened. A lot of economic theory, a lot of valuation work leads their views. In other words, they talk a lot about what the market should be doing as opposed to what the market actually is doing. So I deal in the space of what the data and markets are actually doing, and I don't opine much on what they should be doing. I just deal with where I am. And, you get what you get, and you don't get upset. So we focus on the slopes of the lines. If you hear me talk about the rates of change, again, that's just second derivative math. It's not all that complicated, but again, are things accelerating or are they slowing? I'm not so concerned about whether things are good or bad. Are they getting better? Or are they getting worse, is the way that we talk about it. Now, just to dive into some of the themes that we have currently, or have had in the U.S. this year, we've been debating whether or not we are in what we call Quad 1 or Quad 2. Now, I'll show you what I mean by that in a minute. We also talk a lot about corporate profits accelerating versus the potential for tax reform. I'm on slide 4. And then the biggest risk is a globally synchronized divergent setup instead of what you'll often hear about, whether you're looking at consensus media or wherever you're getting your research, you might hear the term, we are in a globally synchronized recovery. Well, that is true looking backwards. Of course, we're trying to look in the now and looking forwards. We do not see that occurring, and that's one of the bigger risks. China in particular slowing is our biggest concern. But just to focus on what the quads are, I'm not going to geek out on this too long, but again, I think it's pretty simple. And again, I think if you're trying to make macro too simple, you might run into some issues, or you might turn into what we would affectionately call a macro tourist. You don't want to do that, which is kind of reading headlines after things happen and just reacting to them in kind. We have 2 factors that we model, growth and inflation. Those 2 things matter more than anything in macro. So again, what are the rates of change doing in growth and inflation? So while it looks busy, because it's a model, it's not busy or complicated when we're just trying to boil it down. So where is the economy going? And we currently have the U.S. in what we've called Quad 1 to Quad 2. You get spits of inflation, or reflation rather, and you get breakdowns in those inflations. But all the while you stay in a positive growth scenario. As you'll note, in the first quadrant and the second quadrant, they're pro-growth, whereas in the fourth and the third quadrant, you have growth slowing. Now, growth slowing would be a catalyst for an expensive market to go down. I'll show you that this market's actually not that expensive. But notwithstanding, we have a history of making calls on the bearish side as well. I'm not a perma bull, but I am bullish indeed when growth is accelerating. So I just wanted to make that point. That's the quad one. Now, simplistically, if you just want to look at a bar chart of where we are, or where we've been rather, versus consensus, I'm on slide 6. You can see the blue bars are where we've been. And the point that we've been trying to make all year long is that U.S. growth hashtag accelerating is a back-end loaded story for 2017. So in other words, it was just going to get better and better and better, not getting worse. So as you can see, U.S. GDP growth actually got to its lowest point at the end of the, pretty close to the end of the Obama administration. You didn't get those numbers till the third quarter of 2016, Q2 being the lowest number, 1.2%, but you went from 1.2 to 1.5 to 1.8 to 2 to 2.3, and now you're heading towards 2.6. So that's a monstrous acceleration in GDP, and what you get on the right side of that chart, the way that Wall Street reads GDP, they talk about this quarter-over-quarter seasonally annualized number, and I'll just say that quickly because it's completely useless. But at the end of the day, you get headline GDP of 3, which is basically what we've been saying all year long, that eventually by the second and the third quarter, we'd see headline GDP of 3%. So now everybody's surprised and shocked and dismayed, depending on their political opinions. They might be utterly dismayed. There is absolutely no politics in my process. So again, I'm not a Republican, I'm not a Democrat, I'm a Canadian, and I'm data-driven is the way that I look at this. So again, if you look at where we've been, I think that that's probably been the most important thing, that if you ask the bears of 2017, you know, what did you get wrong, and they were being truthful about it, I think what they have to start with is saying, well, we didn't know GDP was going to go to 3. And we didn't know that corporate profits were going to have the best run that they've had in half a decade. And moreover, we didn't see a globally synchronized recovery coming along. So there's a lot of things that the bears missed, obviously, and they've been a little bit whining a little bit about valuation all along. So again, we have a in-house cartoonist here on slide 7. Magic multiples. They're indeed a moving target. Valuation is the answer. Well, what's the question? You know, that's the point. Now, if you can show me what the actual answer is to this question, which is when does corporate profit growth start to slow materially, never mind go to negative, which we just came out of, which I'll get to in a second. Don't forget, corporate profit growth was negative, and you had margin contraction into the lows of that chart in June of 2016. Now, when margins are compressing and growth is slowing, you will see multiple compression, or valuation will not be the catalyst, it will just compress. You know, you'll see lower multiples. But what we've seen, obviously, for the last 5 consecutive quarters is multiple expansion. Multiple expansion born out of margin expansion. So when sales are accelerating and margins are expanding, companies specifically have multiple expansion. Now, here's a good chart for friends and foes of the valuation secrets. Are you sure the market's expensive? Just show your friends this chart. You tell me where the black line should be. Now, this is the S&P 500's P multiple looking backwards, all the way back to the 1980s. You can see that if you called the market expensive in 1996, which is right around this level, you could have been very wrong in 1997, 1998, 1999. By the time you get to 1999, now people are like, oh, this is just like 1999, this is a bubble. It's not. We're nowhere near that level. So again, guess what happens? When growth is slowing, the PE compresses. When growth is accelerating, the PE expands. Now, what I love about this market is that the E keeps going up, so that the PE actually hasn't had to expand that much. So you can see that on slide 10. So again, growth accelerating, we've seen a massive acceleration in earnings, which I'll show you again in a minute. But the massive acceleration in earnings has actually kept the multiple of this market fairly steady. Climbing, yes, but steady, not exploding to the upside like it did in 2009 or like it did in 1998-99. Now, here are the earnings. This is not a dark secret. This is the hard data that the bears are hard to accept, I guess, is the data. You can look at S&P 500 earnings are growing, and this is an update on Q3. Actually, this number is closer to 80% of the companies have reported aggregate earnings growth of around 8% year over year. But as you go down the line, you can see tech has earnings growth of about 25.5%. year over year. So again, not only did it pay to buy growth or to be invested in growth, or the idea that expensive was going to get more expensive, but it paid to be in the growthiest sectors of the market. Now you can see if you just take the Nasdaq earnings instead of the S&P, which are up 8, Nasdaq earnings growth on slide 12 are up 23%. Now over half of the companies in the Nasdaq 100 have reported, so that's phenomenal. And I don't know how else you'd call that. And again, I challenge any bear who's been moaning about valuation throughout the year to tell me that they were telling you to short the market, even though they had the forecast that earnings growth for tech would be in the 20% range, 20 to 25% range. Of course, they didn't say that. So again, this is the lesson, and hopefully people learn. I've had to learn many hard lessons. I've had many mistakes in my career, obviously. But looking at slide 13, this is again, it's data. Data is really important, much more important than your views of Hillary or Trump. And again, I have views on neither that I'm willing to share with you. Information technology. If you go to the fourth line from the bottom, you can see that currently, as I pointed out, earnings growth for the third quarter is up 25.5%. That's the best growth rate that we've seen for tech. Now that's, again, explains largely why you've seen massive multiple expansion in tech. It's exciting. I say to some people, I've been saying throughout the year, that I wouldn't like the market unless it was expensive. If it wasn't expensive, it wouldn't be confirming the view that growth was going to accelerate and earnings were accelerating, would it? Again, that's important. So again, what's going to be a tougher, really a tougher battle ahead here is that you just can't grow 25% earnings growth year over year forever. So I am concerned about that. Everything that was right about this year becomes a much more difficult comparison on a year over year earnings basis in 2018, and specifically I'm looking at Q1 of 18, where expectations are for, fourth line from the bottom, 15.7% earnings growth on top of what was a phenomenal Q1 of 17. That's what really got tech going this year, got the market going. As you can see, Q1 17 down that column of 21.7% was earnings growth, and we were off to the races. So if you bought every darn dip along the way, congratulations. Going backwards, you can see why we're seeing massive earnings growth. That is, of course, because we had an earnings recession. Now, the more political people are, the more reticent they would be in mentioning this, because of course a profit recession is a very bad thing. Now, if you are politically oriented, you might even explain that Trump won because of a profit recession in certain states. But again, that's not the driving factor in our model. Our model is just simply telling you that because we had a profit recession, we're going to see a profit acceleration. So again, you had 5 consecutive quarters of negative year-over-year S&P 500 profit growth. Now, obviously, it's been very green and up and to the right. Now, tech expensive on the wrong numbers, maybe. Look at the earnings revisions in tech. Tech is the green line here on slide 15, and slide 15 is really the point. You know, if you bought the biggest earnings surpriser, you would have bought the right stuff. So again, that's really important. To again look backwards, you can understand with 100% clarity why the Nasdaq 100 for that rather is up 28% and climbing and hitting new all-time highs every day. If you got earnings right, you got the stock market right. Now, tech relative valuation, easily one of my favorite slides to give the bears. And again, I love feeding the bears. I've been bearish many times in my career, and I got plenty of bear meat to give them. And here's one. So if you look at tech's relative valuation relative to either the market or to tech relative to itself. So again, you look at the percentile of where tech's trading. It's in the 66th percentile, going back 30 years. So as you can see in the chart, which is relative to the market, or you can see in the box, which is relative to itself, tech's not expensive. It's not cheap, but it's certainly not as expensive as utilities, or, you know, look at utilities or consumer staples. Utilities are in the 100th percentile of historical readings. That means it's never been more expensive. Okay, so we're actually short utilities. So again, there's always a bear market potentially somewhere, and I think the real overvaluation bubble that does have a causal factor that is affecting it, rising interest rates being, are bond profits. So again, having been a bond bull going back to last year, I'm not anymore on treasuries, but again, we understand what that bubble looks like, and there were indeed bubble multiples associated with it. So that's really a wrap on a lot of the things that I wanted to just kind of table. Also wanted to dive into your questions. That's my favorite part. So again, if you put them into the box, I think we have a couple that have already popped in. Be happy to dig into some of these. I guess I'm going to read these myself. This might be the most challenging part of this for me, by the way. But thanks for your questions. Hi, Keith. What do you think the single biggest risk to investors is right now? I mentioned it at the outset. I'd say that global divergences. What does that mean, global divergences? It means that some parts of the world are going to slow while the U.S. continues to accelerate. So again, GDP I'm talking about. Chinese growth in particular peaked in 2017, this year, in the first quarter. Europe, we actually think, is peaking currently. Parts of Europe, the southern Europe is actually already rolling over. Italy looks quite dire, and Spain is starting to look less good, which is the first thing that matters in rate of change space, is an economy. Europe in particular, if you look at Europe in the aggregate, Germany actually still looks fine. We have that what we call quad one for the current fourth quarter, but into 2018, we would say there's a high probability that China continues to slow from its cycle top established early this year, and that Europe does what Europe always does, which is it slows. So I think that that's going to be a challenge for people, because I think there's a lot of complacency associated with the stock market, obviously hitting new highs every single day, and we're seeing that globally, not just locally. If you look at Japan, for example, the stock market's had one down day in the last 26, which is a new record. And again, I think it's going to get more volatile globally, as locally we continue to see profits expanding at the same time the GDP does, and again, big things like CapEx being up 8% year over year. All that looks great relative to what we would foresee happening, like I said, in China and the south of Europe in particular. Another question. I'm a small investor, have about 250 grand in my portfolio. Which product or products from Hedgeye would you recommend to a small investor like me? Thanks. That one's easy for me. That would probably be Investing Ideas. So that's a weekend product where we have, again, the best ideas from Hedgeye. We have 40 analysts and growing here at the firm, and it's the best ideas that people pay us for institutionally. Don't forget that we don't have a broker-dealer, we don't have a bank, so we don't have an axe to grind. Our only goal here is to be right. So we have longs and we have shorts, and that's what Investing Ideas does. And again, Investing Ideas will give you plenty of longer-term long ideas, and also give you the ones which we're proficient at. A lot of people like to be bearish on things. We like to be bearish with the right timing. There are a lot of short ideas we put in there. So again, the way some people use those is to look in their portfolio and say, wow, Hedgeye doesn't like Tesla, which we don't currently. That's a new idea of ours in the last 3 to 6 months. Then you'll know why you shouldn't, why we don't like Tesla. Obviously, investment banks may not give you all those ideas. Next question. What's your investment outlook for the next 3 to 6 months? That one, I think I articulated there, and if you go back into the slide deck, I think if investment outlook is being driven by growth and inflation factors, again, the most important slide is on slide 6. So again, our investment outlook is largely driven by our corporate profit and GDP outlook, which of course continues to be quite bullish. I'd say that you have to really ask, or I have to ask myself and ask the team, are we currently seeing as good as it gets? I think that's a pretty good question. I guess because I just asked it myself. No, the reality is that 3.1 and 3.0 GDP, we actually have that slowing sequentially, not year over year, in the fourth quarter. So we may have seen the best of GDP for this year, because again, Q3 was just reported. And we may have seen the best of the growth rate of profits, which is important. So again, how much better are we going to get than 26% year-over-year growth in technology on slide 11? I don't know, but it's been actually a quite impressive earnings season. And again, if you look at this on slide 13, you can see that comparing against, if you go to Q3 of 2016, fourth line from the bottom, the 6.1% growth number is what we're comparing against right now, as opposed to comparing against negative earnings growth in tech the prior 3 quarters. See that minus 3.8, minus 7.4, minus 2.7. So it's really impressive that we're now having a more difficult comparison of 6% earnings growth, and we're growing 25.5% against that. That's super impressive. That's why bears are capitulating and bulls are getting somewhat complacent, because at this point, with market volatility hitting the all-time lows, it's getting pretty easy. It's almost embarrassingly easy to be buying the darn dips, so to speak, and I quite like it because there's so many people that are upset about it. I think it feels that way anyway. Let's see. Next question. Do we mention who the asker is? I think from Nick. If earnings are up and inflation is rising, will markets rise, fall, or go sideways? Our call's been that they go straight up and to the right. The closer you are to being long growth, Nick. So again, it's not just about whether the market will go up. I think that those days are a little bit a little bit dinosaur, or old wall as we affectionately call it. The market going up is a pretty broad statement. What parts of the market are going up? What parts of the market haven't gone up this year? Things that don't like it when growth accelerates. REITs, for example, which are interest rate sensitive, they've been terrible. Consumer staples, they've been terrible. Parts of the market, our goal here at Hedgeye is to keep people in the parts of the market that reflect the underlying accelerations that we're seeing. And that's what we're seeing in earnings. So that's why we've been really almost too bullish, I guess some people have called us, on tech, but again, it's because that's where we saw the best earnings growth. So we thought that we would go straight up into the right. We are going straight up into the right. And no, I don't wake up in the morning and call God to tell me what super secret valuation is going to stop us from going straight up into the right. All right, next question. We have another question. What's your favorite sector and least favorite sector? Our favorite sector has been technology. So again, I'm going to stay on that horse. It's easy to ride the horse into year end. Again, my concerns would be more so on tech into Q1 of 2018 when you have to compare, as on the slide I still have up here, slide 13, against the 21.7% earnings growth number. So again, you go to the Q1 17 column, fourth from the bottom. That's the main concern I have with the thing that I like the most. I think it's always important to call out what with my Canadian accent, I guess, you have to call out the risks. I mean, the risk is that it got too hot, and we clearly are hot right now on earnings growth. So, the other thing about timing on that is that while it is a bearish catalyst for something I like, which is tech, Q1 earnings are not going to be reported until April of 2018, and last I checked, it's still November the 7th. It's my son's birthday, so it's an easy one to remember. He's 10 years old. Happy birthday, Jack. And least favorite sector, these consumer staples and utilities, they have high valuations, and they have a catalyst, which is rising interest rates. So again, when you have both, I'm not going to like that sector. So again, the most important thing though is that they have the causal factor which drove their multiples, which are falling bond yields, rising. So bond yields are rising, not falling in the U.S. And that's the main problem I have with these bond proxies that I used to love, by the way. What would get me to love consumer staples, utilities, long-term treasury bonds, any of the ETFs embedded therein, zeros, EDV, extended duration bonds? There's an ETF for everything. What got me to love those last year, or the year prior to that, and into the lows of bond yields last year? What was growth slowing? That was the catalyst for those. So again, we don't have that catalyst for those, and that's why I don't like those. Next question. Does higher oil hurt the bullish economy or the accelerating economy? Well, I think that the higher oil prices definitely helped the stock market, the component of the stock market that was the laggard. Don't forget that energy was the worst place to have your money this year if you look at the S&P 500 sector weights. REITs and effectively MLPs, which were a disaster, and we have plenty of thoughts on that. Kevin Kaiser's our resident bear on that. And again, there's plenty of bear markets if you look hard enough, and we will be bearish on things like that. We don't like levered upstream E&P MLP companies, for example, and some of those companies have actually gone to zero. But again, if you look at energy now, because we're bullish, and we just went bullish on oil itself from a macro perspective, in September, having been bearish on oil, which helped us avoid a lot of those traps, those bull traps, if you will. Now we're bullish on energy, bullish on specifically on oil-related securities, in particular oil itself. So what that does is it keeps interest rates rising. Don't forget that the Fed will see that as hawkish, and rates rising continues to pay the growth bull, and it continues to hurt those who are long of bond proxies. They don't want bond yields rising. They don't want rates being raised. So the Fed's going to raise rates in December, and they should. And the bigger question is after that, when Governor Powell comes in, will he come in under hawkish circumstances, again from growth and inflation perspective, or will he come in to dovish circumstances? And he will come into hawkish circumstances. Again, the data's already been baked into the cake here, and with this move into oil, that only reinforces the fact that they're not going to be concerned about deflation. They'll be, and classically so on a lag. They show up to the party a little late, but I think that those will be hawkish conditions for the Fed to attempt to navigate. Question: what with the financials? With so much cheap money around, shouldn't they be better? Well, I mean, they're pretty close to the all-time highs. I mean, if you look at financials haven't been the leader this year in the stock market. Tech obviously has been, and biotech to a degree. But financials, I think, they had a tough time when what we called reflation's rollover between March and really July, August. So when you had reflation rollover, the Fed had to go back to dovish. Financials underperformed. Now you have reflation reflating. So you have inflation as a factor rising alongside oil. And that has been good for the financials. So we don't buy the financials because there's so much money around. We buy the financials because rates are rising. So again, we're not loosey-goosey about the reason. We're very specific. Is growth and inflation accelerating? If you're in the second quadrant, in other words, in our process, which is basically that's why we're so focused on it. The yellow box, which is called quad 2, is when financials do phenomenally well. Because if you think about it, growth is accelerating, GDP is accelerating, and inflation factors are rising. And currently, post the hurricane, with all the rebuild demand, if you will, and the tightness of certain commodity components out there, you've seen a material short-term or sequential acceleration in inflation. So that's what the financials like. So on all dips, I would still stay with the financials, even though I like tech more. Let's see here. Next question. Key risks to the market. What could make you bearish on the U.S. economy? Well, that's a one-word answer. That's the data. The data. The data. Some people, you watch them on TV. I've been on TV with them. They just talk about what the economy should be doing, and that's why they're bearish. They don't talk about, like in a very methodological way, what the data is doing, measuring and mapping that data every single day. We have 40 analysts. That's all we do. We don't measure the blood pressure of a Republican or of a Democrat. We're constantly measuring and mapping the data. So when Hedgeye gets bearish on the U.S. economy, it'll be purely data-driven. And that's, again, I think it's taken me a long time to figure that out, even though it sounds quite simple. Because when I came out of school, this might be too much information. I thought, like all valuation experts, I got this great education. I know that this stock is too expensive. It should go down because it's expensive. Well, that's absurd. I mean, you would never behave that way with your house, would you? What if your wife or your husband came home and said, "Well, our house is too expensive. We need to leave. This is not right." That doesn't. It's an absurd thing when you consider it relative to other things you might own. Of course, people complain about valuation and because they don't own something. Have you ever heard somebody say, "Well, I'm making too much money on this. It's expensive. It is absurd, and I will stop making money on this. I have to get rid of it today as a result." No. That's not the way that it goes. Valuation is often a scarecrow, and I'm not saying it doesn't matter. I'm saying it's not a catalyst, and that's been one of the main points I've been trying to make. Next question. Keith, on slide 13, comparing the energy sector, worst performing sector, to the tech, best performing sector, I see that earnings growth has been substantially higher than that of the tech sector that hasn't been reflected in the sector's price. How come? Well, if you go, part of this is expectations as well. So if you go to slide 13, you can see now energy, if you go to we're talking about the S&P 500 under the aggregate note there, you see that energy had a depression. Right, you had a depression. So that's, Amir, that's the first point. You came out of a crash and a depression, and now you're just showing strong earnings growth against a crash. Now, the main problem that happened with energy was that energy prices rolled over in the second quarter, and most energy companies, while they were expecting higher earnings growth, they weren't delivering on expectations. So that they were actually, from a beat-miss ratio perspective, we have this in another slide deck, we could show you that the beat-miss ratio was most pronounced in tech beating the most and energy missing expectations the most, even though, to your point, and it's a good point, the growth rate of energy earnings growth has been high. Now, if you look at November, It's very short-term data point, but in November, energy earnings have started to beaten down expectations, and the oil prices start to rise. And the sector is actually, for November to date, which is only 7 days old, it's actually the best performing sector, Amir. So I think that if you get the oil price right and you get expectations right in energy, it's a dynamic situation, because of course you had an epic crash in the price of oil that preceded the attempt of an earnings recovery here. Any more questions? We're combing the queue. I think that's. It looks like I'll give it another 5 seconds.
Well, Keith, while we're waiting for any additional questions, I'm going to take control for just a moment. So I do want to let everyone know, if you've got a question for Keith, go ahead and add it into that questions panel. But what I'm going to do is actually take you out to the Interactive Broker site and show you where you can find some additional information on Hedgeye. Hedgeye has recently been integrated with the Trader Workstation platform, and notice I've just brought it up on your screen. Now if you go to the Interactive Broker website and simply type in Hedgeye, you'll find this additional information. And notice down at the bottom, you can actually request a sample report or go out to the Hedgeye Risk Management website as well. If it is something that you're interested in, I do want to let you know that you can subscribe to a 30-day free trial period. So keep that in mind by going into your account management system. Underneath Trade Configuration and Research, you'll find Hedgeye listed here. So with that, I'm not seeing any additional questions come into the chat panel, or into our questions panel. So I do want to thank Hedgeye Risk Management and especially Keith McCullough for today's presentation. Also want to remind you that we are recording today's session, and we'll be generating follow-up emails to each of you, not only with today's recorded playback, but also with the slides that Keith used for today's presentation. By the way, you'll be able to find today's session will also be listed underneath the Education menu. Go into Traders University, and here you can go into the webinar section, and then notice, view those recorded sessions. Now it will show up in this session later on as soon as I'm able to get this uploaded onto our servers. Well, I do see one additional question that did come in, Keith. We brought that up. So I'm going to toss it back to you. Amir has another question. So we find the Hedgeye 30-day trial version. Oh, that's actually for me. As a link in your emails too. Unfortunately, Amir, I can't include that in the email follow-ups. You will have to go into your account management system and request it through the Manage Account, Trade Configuration, and then you'll find Research subscriptions are there. So you will need to go through account management for that. But if you've got other questions, notice I've pulled up the contact at Hedgeye and email, so please do get in touch with them as well. So with that, that is going to conclude our session here today. Good deal of thanks go to Keith McCullough for a great presentation. Thanks so much, Keith. I also want to tickle Dan in the background, and thank you, Dan, for all your help in getting this set up. But that is going to conclude our event for today. So with that, do want to remind you, you can exit today's event using the X in the upper right-hand corner of your control panel. Thanks once again as well to all of you for your participation here today. Have a great rest of your day, everyone. Thanks so much for joining us. Have a good one.